Hey everyone, George here. So, as we're approaching the year end, it's tax planning season now, and we're finalizing everyone's tax plans and making sure everything has been done right to minimize tax liability and, thereby help increase the bottom line, increase cash flow. So, what I wanted to go over today were by no means advanced strategies, but they're low-lying ducks. They're quick and easy hits to help move the needle in the right direction. So let's get started. So 5 quick and easy hits I wanted to cover today. The first one is prepaying expenses. So the IRS has a safe harbor that you can assuming you're on a cash basis, you can prepay up to 12 months of expenses in the current year and take the deduction in the current year, even though the money covers items for next year. So things that might qualify for this: rent on your office or yard, insurance premiums, equipment leases, if you have any professional or legal fees, bookkeeping fees, things like that. Anything that would relate to next year, you can prepay it like up to 12 months this year, and that's totally valid as a deduction in the current year. This is especially beneficial if this year you had a lot of taxable income to report, but next year things are looking hazy. Like right now, I talked to a lot of contractors, and interest rates being high, housing market being a little soft, projects have slowed down a little bit. So hopefully, if you have cash on hand, and it was a very strong first 2 quarters of 2025, you can prepay a lot of things early on, and it becomes deductible all this year and helps mitigate expenses for next year. Also, another thing, mind you, this is for cash basis businesses, so the cash either needs to post this year or should use certified USPS or FedEx in order to make sure that you can prove that the check went out this year if it takes them a long time to cash. Number 2 quick hitter: stop billing clients in the current year. You can start billing them again next year. So this would work both accrual basis or cash basis. Again, this one's another very easy one. You're basically shifting income from the current year into next year. And this is, again, beneficial if you have good income this year and, you want to move the income, shift it forward to next year. Also perfect for contractors wrapping up year-end projects. And mind you, hopefully things look up next year, but you've also bought yourself another, even though these are just deferrals, they're not actual tax savings. You bought yourself another 12 months to be able to strategize to, legally and validly offset that income next year. So really, you're like buying time in a way. Number 3 quick hitter: buy office equipment and, make your leasehold improvements all in the current year. Again, we've covered this in other episodes, but between Section 179 and bonus depreciation, anything that has a useful life of under what is 20 years will be given that 100% bonus depreciation in 2025 and going forward all the way to 2030. So, if there's any projects that you're looking into, assuming cash flow allows, make those renovations, make those purchases for equipment, machinery, all that in the current year, and we can deduct that entire expenditure, whether you actually paid for it or not, even if you financed it. Number 4, make sure you're using your credit cards the right way. So if you're a sole proprietorship or a single member LLC, you can make sure, assuming that you're running business expenses through these cards, make sure that those are all linked up in your bookkeeping file, and make sure that you're running through expenses. So, and also remember, I see this confusion a lot. Any charges that you make in the current year that transacts in the current year is what we can give you a deduction for in the current year. It doesn't go off of when you paid the credit card bill. You could pay the credit card bill 3 billing cycles later. However, we take the deduction for whatever you ran through the credit card in the current year. So make sure you got all your credit cards lined up in your QuickBooks file, and they're all properly kept up with your bookkeeper. And again, don't be afraid to take all legitimate deductions, assuming they're for a business purpose and you've retained the proper documentation. You should be fine. I see a lot of hesitation, people thinking that they're going to trigger red flags, what have you. As long as it's an actual business deduction and you have the documentation. I have another episode on this, digitizing tax receipts. If over $75, you should retain support for the receipt, what you had purchased. And yeah, I mean, that's about it for that. Number 6, going off of bonus depreciation rules again, new bonus. This is kind of a big one for 2025. Make sure you captured all your qualified improvement property and qualified production property. These are new. These are things that the Internal Revenue Code allows you to take 100% deduction for in the current year. Again, a lot of these projects, they can be financed, not even paid for all in this year, but we can take the deduction this year. So especially if you have a year where you have a lot of income to report, that's very beneficial. So we can offset that entire 100% expense in this year. And for a lighter year, it wouldn't make as much of a difference anyway. So anything under a 20-year life, we can fully bonus depreciate. If you have a real property like real estate, I would highly recommend getting a cost segregation study done once. They'll give you all the items itemized in a way that's very audit defensible, and you can accelerate your depreciation very significantly. You can run through as 100% expense all of the items that are personal property, leasehold improvements, basically everything under a 20-year life. Drywall, lighting, HVAC, electrical, interior remodeling, these are all qualified improvement projects. QPP, qualified production property, this is like if you were to build any sort of property on a lot that you have, including ADUs, including actual full-on structures, and that's used to create tangible goods. I know there's not too many people that do this too often, but if you were to create a plant, I mean, that would give you very significant tax deduction, even though you don't pay for the full build in that year, because almost everybody would finance that kind of thing. So there you have it. These are quick hitters. Make all your prepayments this year if you can. Hold off on invoicing until January. Buy and place equipment in service before the end of the year. Charge expenses on your business credit card before the end of the year. And use QIP and QPP for any building 100% bonus depreciation. So I know these aren't the most advanced strategies, but they're things to keep in mind. They can really make a big difference as we approach the end of the year. And these are things that you don't even need a tax professional or some heavy expert to help you through this. These are things you could just tell off the cuff to your bookkeeper. So I hope you found this helpful. Click like, subscribe, turn on notifications for any other updates, and I hope to see you in the next one.